Are you investing through mutual funds and doing those regular SIPs every month? If so, you might be making some common mistakes that could cost you a fortune in the long run. But fret not, because we're here to guide you through 5 essential mutual fund investing strategies that you must know. Let's kick things off by shedding some light on what mutual funds are. Mutual funds are like financial vehicles that pool money from numerous investors and invest it in a diversified portfolio of stocks, bonds, or other securities. There's a popular choice for individuals looking to grow their wealth without the hassle of managing individual investments. However, if not approached strategically, mutual funds can lead to missed opportunities and financial pitfalls. Now let's delve into these 5 must-know strategies that will help you make informed decisions, maximize your returns, and avoid the pitfalls of the mutual fund world. But before we dive in, show us some love by hitting that like button and subscribing to our channel for more of our valuable financial insights. For now, let's get started. Number 1. You need a crystal clear understanding of why you're choosing a specific type of mutual fund. The world of mutual funds offers a plethora of choices, but let's focus on the Nifty 50 Index Fund as an example. This index comprises India's top 50 companies, including giants like HDFC, Hindustan Unilever, and Nestle. If you're new to mutual fund investing and seek a secure option, Nifty 50 Index Funds are a wise choice. The top 50 companies are financially stable, making them a safe haven for your money. Despite the temptation to entrust your investments to a professional, statistics show that around 78% of large-cap mutual funds in India fail to surpass the Nifty 50 or Sensex indexes. Therefore, for a straightforward and secure investment, opt for Nifty 50 Index Funds. What's more, since these funds are passively managed, employing algorithms or computers to track the index, you don't need to pay high mutual fund manager fees. Look for an index fund with a low expense ratio, such as the Reliance Mutual Fund, which charges a mere 10 rupees for every 10,000 rupees invested. While other mutual fund options exist, for the average investor starting out, sticking to a Nifty 50 Index Fund is a smart choice. Individual large-cap funds may seem enticing, but often come with higher expense ratios, and even if they outperform the index slightly, their added fees can eat into your profits. Avoid this pitfall into your mutual fund journey. Number 2. Large-cap mutual funds are ideal for those with long-term investment horizons, typically spanning 10 to 15 years. Understanding mutual fund investing boils down to recognizing the wide range of stocks, each delivering varying returns. While it's impractical for average investors to closely monitor their funds and the markets over a decade, professional fund managers play a crucial role. They identify stocks with the potential to significantly outperform the index. For investors with long-term goals, seeking mutual funds with proven track records is wise. Options like Reliance Mutual Fund's Large Cap Fund, or those from Franklin Templeton and Aditya Birla, known for consistently outperforming the Nifty 50 Index, are solid choices. Starting your mutual fund portfolio with simplicity is key, especially for beginners. If you're young and can invest 20,000 to 30,000 rupees per month, consider beginning with a single mutual fund like a Nifty 50 Index Fund. Diversification into small cap or mid cap mutual funds may not be suitable for newcomers. It's essential to grasp the concept of investing in leaders in the stock market marathon. Young investors should focus on mutual funds, consistently selecting front-running stocks, allowing you to stay ahead of the curve. As you reach your mid-40s or 50s, you can explore mid-cap mutual funds, but for those in their mid-20s or 30s, it's best to hold off on such investments. Keep in mind that starting simple with a Nifty 50 Index Fund or a reliable large-cap fund is advisable for new investors. Avoid rushing into small-cap or mid-cap funds, which tend to be more volatile and carry higher risks. Take the time to gain experience and better understand your investment strategy before diversifying your mutual fund portfolio. Mutual fund investing is a long-term commitment that should align with your financial goals and risk tolerance. Diversify wisely, consider your experience level in the mutual fund landscape. Number 3. Mutual fund managers often struggle to keep track of the returns generated by their portfolios. How many of us can confidently state the exact return on our mutual fund portfolio? When was the last time you checked it? Unfortunately, many investors don't bother understanding the difference between a good return and a bad one. A savvy investor can achieve a 16% return CAGR or compounded annual growth rate in the market with relative ease. Why? Through index investing in India, the simplest form of investing, you can realize a 12.2% CAGR. History and mathematics support this claim. If you seize opportunities during market dips or time correction phases, you can aim for a 16% return. Buy low, as we discuss in our course and live meetings where our community shares strategies and experiences. Join us if you're interested in learning more. Now, some may argue that index investing can consistently bring in around 12%. Why bother with anything else? Let's break down the math. Consider investing 25,000 rupees at a 12% return for 10 years, assuming you're 30 years old. Your portfolio would reach a significant value. Now let's switch that to a 16% return. The difference is clear. Over 10 years, you could see substantial gains. But the real game changer is when you extend the investment horizon. If you're in your 30s, 40s, or even 50s, and can envision investing for 30 more years, it has a profound impact. Look at the numbers. A 12% return over 3 decades leads to a substantial portfolio. Now change that to a 16% return and you'll see a transformation. This is the difference between securing wealth for yourself and potentially creating lasting riches for future generations. It's true that the stock markets can make you wealthy through equities alone, but unless you delve into direct stockpiling and invest time in learning, the likelihood of your future generations attaining tremendous wealth through your efforts is limited. Number 4. It's crucial to grasp the significant commissions you pay to your mutual fund agents and managers. This expense often goes unnoticed, but it can significantly impact your overall returns. Non-index funds tend to have higher commission costs, ranging from 1 to 2% or even more. It might not sound like much, but when you break it down, the impact becomes clear. Let's do some simple math. Imagine you invest 1 lakh rupees and your money grows by 10%. That should result in 1.1 lakhs. Now, if you're paying a 2% commission on the entire amount, that amounts to 1.8 lakhs as your final balance. Effectively, you paid a 20% commission on your profits. This becomes more concerning when you realize that even in years when your portfolio isn't performing well and is in the negative, you're still paying that commission. The issue is transparency. The mutual fund industry often doesn't directly inform investors that they'll be charged a significant percentage of their profits, and this can erode your returns over time. When investing, it's essential to focus on your profits, not just your initial investment. Profits are what you take away from the market, and paying large commissions can significantly impact the amount you're actually earning. So it's important to be aware of those hidden costs and seek transparency in your investments. Number 5. Knowing when to exit a mutual fund is a critical aspect of investment success. Exiting mutual funds share similarities with existing stocks, but it's essential to understand the key indicators and timing. Market phases where your investments seem stagnant can be frustrating, but these are common occurrences in the stock market's cyclical nature. Retail investors often panic and make hasty decisions during market downturns. It's typical for people to sell when markets are falling, stop their systematic investment plans or SIPs, or even withdraw their SIP investments during times of uncertainty. However, these actions are generally detrimental to long-term investment success. Instead, intelligent market timing involves selling when the market is overvalued. Overvaluation can be assessed by evaluating market patterns, economic factors, and financial indicators. Understanding these signs can help you make informed decisions about when to exit a mutual fund or equity investments. It's essential to develop a strategy that considers market conditions and your long-term financial goals rather than reacting impulsively to short-term market fluctuations. Number 6. Understanding the psychology of mutual fund managers sheds light on the final point. The reality is that mutual fund managers often lack a strong incentive to deliver consistently high returns, such as 15% CAGR or compound annual growth rate each year. While this might seem like an irrational statement, it's essential to explore the reasons behind it. Firstly, statistics show that approximately 78 to 79% of active mutual fund managers in the large cap category fail to outperform the index. This is a significant figure, and it highlights the challenges faced by many active managers. For retail investors, the choices can appear limited. Comparatively safe options like fixed deposits or government bonds offer relatively modest returns, often around 6 to 9%. Mutual fund managers are well aware of these conservative choices, and their targets are often set accordingly. They aim for a more attainable 10% return as it seems attractive compared to options like FDs. The concern for mutual fund managers is that setting expectations too high, like 15 to 20% CAGR, can lead to unrealistic investor demands year after year. This scenario can create a never-ending cycle of rising expectations, which can be difficult to meet sustainably. Therefore, many mutual fund managers focus on more modest returns and aim to meet these expectations consistently. To truly accelerate wealth creation, investors must consider venturing into direct stock investing, where they can apply their learning and potentially achieve high returns by navigating the market themselves. And that's a wrap for today's insights on mutual fund investing. Which one of these investing strategies caught your attention? Let us know in the comments below. If you found this video helpful, don't forget to give it a thumbs up and hit that subscribe button to stay tuned for more valuable financial advice from Luxo-Life. Thanks for watching.